Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden messages in corporate filings. And today we are about to unravel a real transformation story. One where a fund is not just changing its name, but its very nature. Get ready to dive into a world of reorganized funds, new advisory structures, and a potential big leap onto a major stock exchange. Before we dive in, if you are someone who loves getting the inside scoop directly from the source, make sure you are subscribed to Corporate Decoder. And hey, join our Discord community linked in the description below for even more discussions and insights. We're all about demystifying these complex corporate documents together. So what we have here is a filing with the US Securities and Exchange Commission, or the SEC as it is commonly known, from a company called FS Specialty Lending Fund. It tells us about some pretty big changes that have just happened. Back on the 22nd of April, the folks in charge, their board of trustees, decided it was time for a significant shift. They were going to take FS Special Lending Fund, which was operating as a business development company, and turn it into a closed-end fund. Think of it like this: a business development company is often more like a direct lender, while a closed end fund is a company that pools money from investors to buy securities and operates with a fixed number of shares. This was all done through a merger. The old fund basically merged into a brand new fund that was set up specifically for this transition. It's a bit like a company rebranding, but on a much deeper financial and operational level. And guess what? This big change, this reorganization, was officially completed on the 28th of October 2025. Following this completion, the fund officially became known as FS Special Lending Fund. The name we see here, it was essentially a shell entity created to facilitate the switch from being a business development company to this new closed-end fund structure under the Investment Company Act of 1940. Now here is where it gets really interesting. This newly formed closed-end fund has plans, and big ones at that. They are aiming to list their common shares on the New York Stock Exchange. The NYSE, this proposed listing is currently expected to happen sometime in mid-November. However, and this is a big however, these things are never a sure bet. Market conditions and the approval of their own board play a huge role. So, while they hope to be on the NYSE soon, there is no guarantee it will happen exactly as planned, or even at all. Until then, they'll be operating as an unlisted fund. Along with this reorganization, a few crucial agreements were put in place on that same the 28th of October date. The fund signed on with their investment advisor, FSI Advisor, LLC, for an investment advisory agreement, a fee waiver agreement, and an administration agreement. Essentially, the advisor will continue to do what it was doing for the old fund, but now for the new structure. Let's talk about the money side of things, because that is always what gets people talking. Before their planned listing on the New York Stock Exchange, the fund will pay their investment advisor a management fee. This fee has two parts. First, there is a base management fee. This is calculated at an annual rate of 1.75% of the fund's total assets. So, the bigger the fund gets, the bigger this fee becomes. Second, and this is the more complex part, there is an income incentive fee. This fee is calculated quarterly, and it is a chunk of the profits the fund makes. Specifically 20% of what they call pre-incentive fee net investment income. But there is a catch, or rather a hurdle. They have to clear a rate of return of 6.5% on what they call adjusted capital. Adjusted capital is basically the money investors have put in minus some specific payouts. If they clear that hurdle, the advisor gets a portion, and if they really soar past it, they get an even bigger percentage. Now, here is where the planned NYSE listing changes things after they're listed. The fee structure shifts, the base management fee actually goes down slightly to an annual rate of 1.50% of the fund's gross assets. That is a small but noticeable reduction, which is good for investors. The income incentive fee also changes. The hurdle rate, the profit target they need to hit before the advisor gets a bigger cut, drops from 6.5% to 6.0% of the fund's net assets. And again, there is a catch-up provision where the advisor gets an even larger share once certain profit levels are met. But wait, there is more good news for investors, or at least a potentially good deal. The fee waiver agreement means the advisor has agreed to temporarily reduce some of these fees. Specifically, they're waiving 0.15% of the base management fee, and they're also cutting the income incentive fee down to 10% of the incentive net investment income. This fee waiver is effective once the fund is listed and will continue until the fund is no longer registered under that Investment Company Act unless it is ended earlier with the board's approval. As for the administration agreement, the advisor will handle the fund's day-to-day operations. Keep the financial records, prepare reports for shareholders and regulatory filings, oversee tax returns, and manage expenses. They don't get a separate fee for this, but the fund will reimburse them for costs related to these services. And yes, as we mentioned, after all this shuffling and reorganizing, the fund officially changed its name to FS Special Lending Fund. There was also a separate but related deal happening at the same time called the advisor transaction. Franklin Square Holdings, or FS, acquired the interest of IAG Asset Management LLC in the advisor, so as of the 28th of October, the advisor became fully owned by FS and even changed its name to FS Special Lending Advisor LLC. The people who were already managing things pretty much stayed on board, which suggests a smooth transition from an operational standpoint. And that basically wraps up the main updates here. It confirms the details we've already touched upon regarding the agreements and the overall reorganization. Item 9.01 is where they list the accompanying documents. Here we see 3 key agreements filed: the Investment Advisory Agreement, the Fee Waiver Agreement, and the Administration Agreement, all between the fund and the advisor. And as with most filings these days, there is also a cover page interactive data file. Finally, we have the signatures. This confirms that the filing is being made on behalf of FS Special Lending Fund, acknowledging its status as the successor by merger. The date is the 28th of October 2025, and it is signed by Stephen S. Sifford, who holds the title of General Counsel. Now, let's put on our analyst hats and look at what all this means. The core story here is a business development company transforming into a closed-end fund and aiming for a public listing on the NYSE. This is a significant strategic move. The fee structure and the fee waivers are crucial for attracting investors, especially as they prepare for a public offering. The reduction in management fees post-listing and the temporary fee waivers are positive signals for potential shareholders, indicating a focus on attractive yields and investor returns. The risks here are pretty clear. The success of the planned listing on the NYSE is paramount. If market conditions turn sour or if investor sentiment shifts, that listing could be delayed or even called off, leaving the fund in an unlisted state. Also, the performance-based incentives for the advisor mean that while they are incentivized to generate strong returns, a significant chunk of those returns could go to them, especially if the fund performs exceptionally well. The calculation of pre-incentive fee net investment income and the various hurdles will be critical to watch, as they directly impact how much of the fund's earnings are retained by the investors versus paid out as advisory fees. On the flip side, the move to a closed end fund structure might offer more stability and predictable capital for their investment strategies compared to the potentially more fluid structure of a business development company. The fact that key personnel are continuing under the new structure suggests operational continuity, which is a good sign. In conclusion, FS Special Lending Fund is embarking on a major transformation. The success hinges on their ability to execute the NYSE listing and then deliver consistent returns to justify the advisory fees and unlock value for their shareholders. The fee adjustments show an understanding of what it takes to attract public market investors. It is a strategy that could pay off handsomely if executed well, but the path to public trading and sustained performance will be closely watched. Alright, that is our deep dive into the FS Special Lending Fund's recent filings. What are your thoughts on this transformation and the proposed NYSE listing? Let us know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate decoded insights. And don't forget to join our Discord community for ongoing discussions. Link is in the description. Thanks for watching, and we'll see you on the next one.